today's world, having a basic understanding of finance and small business management is crucial. In our ongoing 4-part series, we've already covered the characteristics of a profitable versus an unprofitable business, as well as investing in initial public offerings, IPOs, and how to capitalize on them. Today, we will go over the important keys to understanding successful investing. Welcome back to Knowledge Pilot. Chapter 1: The Power of Compound Interest. If you want to be a successful investor, starting early is one of the most important things that you can do. If you can save $5,000 at 25 and make 12% on it until retirement, you'll be set. What would you have in 40 years? The answer is that if you set aside $5,000, didn't save another cent, and invested it and gained 12% on it each year, you'd have $465,000 in 40 years. In year 1, your $5,000 would earn $600. In year 2, your $5,600 would rise by 12%, and so on. This compounding effect causes money to grow passively. Recapping, if you saved $5,000 when you were 25 and waited 40 years, you'd have $465,000. That's actually pretty good. What if, for some reason, you had to wait until you were 35 before you could make the same 12% compounding annual interest? Problem is, by year 30, you will be 65, the typical age of retirement, but you'd only have $150,000. Likely, that isn't enough to retire on. This highlights the importance of investing now rather than later. You want to get started early so that your money can grow over time. How about compounding interest at 17% annually? We have seen that at retirement age, you would have $465,000 with 12% interest. That's good, but 17% would give you nearly $2.7 million. Undoubtedly a fantastic position to be in. Wise money management can make a big difference in your retirement assets. Investing even $5,000 will, over time, provide you with financial freedom. Now, just as a thought experiment, let's say you were one of the biggest investors of all time, like George Soros or Peter Lynch. If you could earn 20% annual interest for 40 years on your original $5,000, you would have $7.4 million. Evidently, the greater your interest rate is, the more that you will earn over time. This is an example of the exponential growth, that is compound interest. Chapter 2: Managing Risk. The prospect of earning money is exciting. However, like all things in life, there are risks involved in investing. Let's talk about the chance of losing money now. Let's assess your situation if it took a lot of risks to try to get a 20% return. Assume that every 10 years, you lost half your money because you made a bad trade or the market went through a recession. Well, your $7.4 million at an interest rate of 20% would now only be worth $919,000 in 40 years. It is unlikely that during your investment journey, you will avoid losses entirely. However, it is important to try to minimize your losses when they do happen. So how do you become a successful investor when there's all this risk? How do you avoid losing money? What are the good places to invest? Managing risk tip number 1. Our first piece of advice is to avoid investing in startup businesses where the prospects are not very well known. Again, you don't need to double your money every year to have a fortune. You just need to invest at an attractive return of 10 to 15% over a long period of time to see your money grow exponentially. How can you stay away from high-risk investments? We advise investing only in public securities on the stock market. Before going public, companies must meet many legal requirements. If you buy stocks in a public company and later change your mind about it, then selling the stocks is easy because they are readily available to liquidate. Returning to our example, your stake in a private iced tea stand cannot be sold easily because it would be very difficult to find a buyer of your shares, unless the business is extremely profitable. Thus, the first piece of advice is to invest in public businesses. Managing risk tip number 2. You want to invest in businesses that you understand or that you can easily learn about. If the business is just too complicated, you won't understand how they make money or if their operating methods are reliable. Understand what you buy and sell. Knowing this will prevent unwise investments. Managing risk tip number 3. Another crucial factor is price. It could be a great business that does very well over a long period of time. But if you pay too much for it, you won't get a very good return on your investment in that company. Managing risk tip number 4. The next step is that you want to invest in a business that you could theoretically own forever. You need a consistent business to compound your money at 10 or 15% over 40 years. You don't want to keep switching businesses. So, what qualities should a lifelong business possess? You want a business that provides a product or service that people need, is unique, and has a dedicated customer base that is prepared to pay a premium. In short, you want the product to be one of a kind. Managing risk tip number 5. Further, if you're investing long term, try to invest in companies that have low debt or have a low debt to asset ratio. Your iced tea stand from the previous video is a good example. There is only $250 of debt. That didn't put too much pressure on the iced tea stand company. But if it had been $1,000 and you hit a rough patch, it could have gone out of business for failure to pay its debts. The investors could have been wiped out. Managing risk tip number 6. You also want a business that have a high barrier to entry. You want a business that's hard to copy and compete with. Seek something where consumers are loyal and won't switch, even if someone provides the same comparable product for 20% less. A fantastic example of this would be a pharmacy company that produces a drug that no other pharmacies are allowed to produce. That company will face no competition unless a better alternative solution becomes readily available. Managing risk tip number 7. You also want businesses that are not sensitive to outside factors or intrinsic factors that you can't control. For example, if the price of a certain good goes up, if the interest rates go up and down, or if the price of a currency changes, a company that isn't sensitive to intrinsic factors will not be greatly impacted by these changes. You want to find a company that is immune to what might happen in the world. Managing risk tip number 8. Finally, our last recommendation of things to research when investing in a company is the cost for that company to reinvest in itself. Here is an example. A company with high reinvestment costs could be an airplane manufacturer like Boeing. For that company to reinvest and start producing a new airplane, they would need a huge amount of capital to grow. Conversely, a company with low reinvestment costs, such as your iced tea stand, means that the company can more easily allocate its earnings towards other opportunities for growth, or distribute profits to shareholders as dividends, rather than having to continually reinvest them to maintain operations. This can make the company more attractive to investors seeking a balance between return on investment and stability. A company with lower investment costs will likely provide greater returns on your investment. These are just some of the key criteria to think about. You must ensure that the management and the people that control the business think about you, the shareholders, as an owner and are going to protect your interests. So now you know the keys to successful investing. But this is just the third part of this 4-part series. In the next video, you will learn about the psychology of investing and mutual funds. We hope you liked this video. If you want more information on this, check out our other videos on the screen. Thank you for watching.